I'm Keith McCullough, and welcome back. If you've stayed 3 for 3, I'm impressed, because you're tolerating me while we have these great guests who are going to educate you on topics that you need to know about. On this topic in particular, inflation, hard assets, equity-linked investing. There are very few people that are as accomplished or as well known by people who would know about that than Murray Stahl. So thanks for making the time. This is a real important time to have this conversation.
Well, thanks for having me.
It's not the first one we've had, but certainly the manifestation of inflation over the period, not just the period when you guys started Horizon Kinetics, or the ETF that they have is INFL, which all of our subscribers know about, which is it $900 million now?
About $900 million.
It's a huge success, right? It's very hard in a world of ETFs. Rooster, my analyst who runs it every night, he's like, "Hey Keith, I added 350 ETFs last night." I started laughing. Whoa, how'd you all of a sudden get 350 more? And we already had 3,000. And the punchline is that not many get to 900 million. So, congrats on that. And I wonder if that speaks. I mean, it speaks to the success of the stock picks in the portfolio, but it's also the topic. I mean, you got a great ticker, INFL. But it's also been the story. I mean, it's the story in America that most people at the Fed or people in politics don't want to talk about.
Well, my opinion is just starting.
Okay.
The inflationary trend.
That's so we're like, what duration are you talking on? Like, how long can this last?
It can last decades, because it was 4 decades approximately of disinflation. So you really can't understand inflation without understanding disinflation, which preceded it. Mm-hmm. So I would call it 2.5 miracles that prevented inflation the last 42 years. First miracle was the collapse and the prelude to the collapse of the Soviet Union. Mm-hmm. So say what you will about the Soviet Union, they did possess all manner of natural resources, anything you can possibly imagine. And looking to save themselves, ultimately they did not, but looking to save themselves, they placed all manner of natural resources and commodities on the global market, which broke the inflationary trend. So that's the collapse of Soviet communism. Chinese communism was a little bit different. Wasn't functioning very well, I dare say, but they don't have natural resources to speak of. Here and there, perhaps, but nothing really material from the world economic standpoint. What they did have is 1.4 billion people. So they put 1.4 billion people on the global labor market. And then China had its imitators: India, Pakistan, Bangladesh, Thailand, Vietnam, Philippines, et cetera, et cetera, et cetera. Therefore, I don't think it's an exaggeration to say, over the course of some decades, 3 billion people came on the global labor market. And that's why so many global multinational companies could have higher profit margins, because there's a labor arbitrage. Mm-hmm. I said 2.5 miracles, not 2. There's a half miracle in there. So what's the half miracle? With the collapse of communism, both Chinese and Soviet, all of a sudden the global multinational companies could expand to geographies that were previously denied to them. So could you imagine in the 1980s if you had said, I think the day will come when there'll be a McDonald's in Shanghai or Beijing? You would have been thought to be a madman. Mm-hmm. You would have been thought to be a madman if you thought there would be a McDonald's in Moscow. I don't think there is a McDonald's in Moscow right now, but there was. So that happened as well. So those are the miracles, and that's over.
Mm-hmm. And what happens after the miracles? Is it gravity? I mean, it's base effects plus gravity, I would call it. But I mean, how do you think about the coming out of the disinflation?
Well, now the problem is that every major country in the world runs a tremendous balance of payments deficit and runs a tremendous budget deficit. And China is the beneficiary of the trade, and to some extent certain countries in the Middle East because of oil and natural gas, but it can't continue. There has to be a reckoning. Mm-hmm. And the reckoning will come. And actually you could argue it's already coming. Mm-hmm. Because we do have the beginnings of inflationary pressures. We just don't measure it appropriately.
Do you agree that the only 2 ways out of this are through deficit spending or through austerity?
there's no way out that's sudden. The only way out, if you're going to do austerity, the population will be prepared for that. So that would have to be very gradual, if it's even achievable, which is very doubtful.
So you couldn't have like the equivalent of abrupt policy change like Volcker on rates. You couldn't do that with austerity. That'd be too shocking. Too quick.
I don't think that, given the leverage that we have, there are things we have in the economy that didn't exist in 1982. As an example, private equity.
Mm-hmm.
Private equity is essentially leveraged equity. So it's at least $5 trillion worth, probably more, and with the debt that accompanies that. So it's too dangerous. The bank balance sheets, I mean the commercial bank balance sheets, are just many orders of magnitude bigger than they were in the 1980s. The consequences are just difficult to contemplate, so I don't see that happening.
So deficit spending, I mean, some people actually say that deficit spending with debt at these levels is not inflationary. Like, should we even entertain that, or do you want to talk about that?
Well, I'm open to I have an open mind in any concept, but we are spending, let's put it this way, it's not merely deficit spending. So we will define our terms. It's a $7 trillion budget. We spend $7 trillion. We have to add to that another almost $4 trillion spent by state and local government. Mm-hmm. And to that, we have to add much, much more. Why? Because we have Fannie Mae, Freddie Mac, Ginnie Mae. They create money. They're controlled by the government. They're, believe it or not, if you had those balance sheets, you have a balance sheet more or less the size of the Federal Reserve. Then there's the World Bank. There's the Bank for International Settlements. There's the International Monetary Fund. And then, in the United States at least, there's all the small agencies that are self-financing. Example, New York metropolitan area, Triborough Bridge and Tunnel Authority, and the MTA, and so on and so forth, New York State Dormitory Authority. So tremendous quantities of money are being expended, but we don't have the industrial base in the United States any longer to produce accordingly. So we're going to get inflation.
That point that you make on what we've, I'm trying to think of the slide that I have where, on the one hand, there are a lot of ways that you can get inflation just by I say base effects, right? After something goes one way for 40 years, the base effects are very easy, so you can see it go the opposite way just on that. But once you have these big causal things like labor, like when you take that Chinese labor piece and its manifestation into the stands all around the world, and now you start to get into a different kind of a world where everyone goes inward. And inward in the US, like I show this all the time, but we live in a like a 6% nominal environment because you talked about state and local. I mean, that's like state and local plus unions, you start to add all that up, and there's no abating that. You can't take that back. Like nobody's working for the government getting a 10% pay cut. All these incremental workers have come in at the highest actual rates of change on wage growth that we've ever seen in the model. So does that all go together?
Well, that and more. So for example, something that everybody knows, we're moving into a world, however you want to call it, high performance computing, cloud computing, data centers, artificial intelligence. It's going to require unbelievable amounts of electric power, mm-hmm. which will require unbelievable amounts of energy. Where will it come from? Where will the water come from to cool the data centers that will be constructed? As a matter of fact, if you really want to talk about the simplistic thing of inflation, there is a lawsuit against Microsoft and OpenAI pertaining to intellectual content of authors. So essentially, everything ever written, every scholarly article, every book ever written is probably stored in a database somewhere. Mm-hmm. And that's being used in AI. And there are a number of federal lawsuits right now. The authors would like to be paid for intellectual property. So if they're going to be paid for intellectual property, I suspect they will be, then that has to be reflected in the price of the data center services.
Yeah, it's interesting how on the front end, the Wall Street in particular, and certainly retail investors, and that's not a compliment being called one of those, but we like to say a macro-aware, self-directed investor, somebody who understands to buy INFL, buy gold, a gold mining company, or in the case of, you get a lot of different ideas I want to go through, but you cannot, you watch people you try to deal with this, and they kind of get to a place where they don't. And I don't know how on the one hand you could be so infatuated with NVIDIA and AI and the price of these chips, the inflation in the chips relative to the former chips and the supply shortages, and not come up with an inflation story. Wall Street is still saying inflation is going to go towards the Fed's target. In the next 3 quarters, it's going to go towards 2% because that's what they said they wanted.
Well, it depends how you measure inflation. That's one of the, I myself would argue it should be measured differently than it's measured.
Can we go through that?
Yes.
First and foremost, welcome to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? Like, how many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
The first thing is the measurement we get is accurate. It's not inaccurate. But it's not measuring a constant or stationary basket of goods and services and how the prices changes. The basket of goods and services is constantly being changed, and for 2 ways. One is called the chain link method. We would call it the substitution method. So very simplistically, you're buying something, the price goes up. The algorithm assumes you will substitute for a less expensive good. You're consuming a certain amount of beef, the price goes up, you'll consume chicken instead. And you could actually construct a variable basket of goods and services where the price doesn't change very much. I can even give you, if you have a minute, I'll give you an example of that.
Yeah, for sure.
So let's imagine a world, a preposterous world, but all we need to survive, we don't need shelter, we don't need clothing, we don't need medication, we don't need education. All we need is 2 pounds of beef and 3 pounds of chicken, and we are good for the year. That's it.
My son would probably go for that, my teenage son.
Well, anyway, we're saying that because we want to speak simplistically to understand the arithmetic involved. And let's assume the beef is priced at $4 a pound, the chicken is priced at $3 a pound. So very easily, 2 times 4, because it's 2 pounds of beef, is $8. 3 pounds of chicken times $3 each is 9. 8 and 9, 17. That's your base. That's your expenditure for the year. The price of beef now rises to $5. Well, obviously, after we work through the calculation, you're going to have inflation. The algorithm would say something like this. You're now going to consume 1 pound of beef and 4 pounds of chicken. 4 pounds of chicken is $3. That price doesn't change, it's 12. 1 pound of beef is 5. And 5 and 12 is 17. Voila. The price of goods and services has not changed in our imaginary basket, and we have no inflation. That's one dimension of it. And that's how the system works. There's another dimension of it, which we call the hedonic adjustment. There are changes in the quality of goods and services. So if our health insurance premiums rise, they rise not because of inflation necessarily, they also rise because the number of therapies and treatments for ailments is constantly improving, getting more effective, and there are some therapies that didn't exist previously. So obviously they'll be covered by insurance, but now from the insurance company point of view, there are more payments that need to be made.
Yep.
Clearly, your insurance premium has to be adjusted accordingly. So your insurance premium is going to go up. The hedonic adjustment says, well, that's not inflationary. You're getting more for your money, and it's true. But if you're a person who's just trying to measure how much do I need to live on, well, your price, your basket of goods and services is more expensive. And there's a lot of empirical evidence to suggest that people do try to change their purchases, maybe consume less or consume more inexpensive items in the presence of inflation. The trouble with that calculation is, if you're a wealthy person, you can do that. If you're at the lowest rung of society, you're already doing that. You can't do it. And therefore, you're not really measuring what you'd want to measure. So if you're going to make for Social Security cost of living adjustment, as a generalization, of course there are exceptions, but as a generalization, the people on retirement incomes, they're close to the lowest rung of society. They're not necessarily able to amend their purchases. So as a policymaker, you need to know that, although you might also want to know how people are coping with inflation.
It's crazy, especially given the size of the retirement demographic,
Right.
you know, and where we're at. It's just not. You don't have. It's a very odd thing, especially in this day and age where everyone's supposed to know everything. You've got AI, right? But we can't actually have the Federal Reserve talk plainly about these things. Like, I can model it. We model it every day. I wonder what you think about it. I mean, it's been accurate, like with, you know, very high batting average. More so the direction of inflation, because to your point, with all the adjustments and the kind of like, well, CPI, I mean, it's been changed like 9 times since 1996 or something. I mean, the components. But if you get the actual rate of change, if it's going up or it's going down on a trending basis, right, that's super valuable. It instructs bond yields, it obviously instructs commodity investing. But we basically take a commodity price sample basket. Like, so for example, like I was just showing yesterday, beef prices are up 18% a month, just to use your beef example. Or this morning, I'm showing the move in cheese prices. They were up 8% in a day. I mean, year over year, the prices are up. The guys can show it if you want. I think north of 40%. You start to run out of things in your theory. Like, if now I can't have a cheeseburger, right, with those two things, because now I have to go to your chicken. But the big chicken, you know, now you got the Big Mac is chicken, so all the chicken's going up too. So you got it's crazy to me, like, that in this day and age with all this information, all this computing power, that there's a little firm in Stamford, Connecticut that can advise, you know, trillions of dollars under management, and they'll take it as truth from us. But the Federal Reserve doesn't want to talk about it.
Right, but to be fair, we got to be fair to them too. To be fair, you know, I'm getting more sympathetic to them as I get older. I don't know why, but I really am. Everybody likes to criticize
Because you just
them.
feel bad for them.
Well, no, because first of all, there's an element of subjectivity. When you start changing the basket, there's an element of subjectivity in it.
Of course.
So it's hard to get it right. That's the first thing. Second thing is, there's a political dimension. When you make a statement that inflation is not 3, inflation is more like 9, the political dimension of that is just mind-boggling.
Well, people, I mean, but the other, what's interesting about that statement is that the other side of the commentary is widely distributed. In Austin Goolsbee, who's a political hack at the Fed, and people can look up how he actually got that job, which was totally sketchy. It was through the elites. That's how you get appointed to these things. He's calling this a Hall of Fame year for inflation. Now, when my dad hears that, who's a 70-year-old, you know, retired firefighter on the budget you're talking about, he doesn't care. Like, my dad was the head of the union. The guy leans left. I mean, he's like, that's total bullshit. Like, Keith, what's up with this Wall Street thing? Like, what's up with these people at the Fed? Like, that's the answer. The people are increasingly, like, calling these guys out, and that's part of it too. The information era, everything's out there.
Well, that's true, but they can feel it in their daily experience. They can't buy what they used to buy. So their standard of living is going down.
Right.
And it's expressed in a lot of discontent. So some accommodation is going to be made with them ultimately. When that accommodation is made, it's just going to be more inflation.
Right. But the discontent, though, puts an even bigger premium on the entitlements, right? Imagine we took my dad's pension, like, took his, you know, take the COLA payments out, you take it, like, people would lose it, like revolution type lose it, I think.
Well, it would be very upsetting, let's put it that way,
So
to a
you
lot of people.
so you keep the one thing that's most causal. I mean, do you agree? I think is the rate of change of money supply causal to inflation?
It's certainly a contributory factor. It's not the only factor.
Not the only factor.
Not the only factor. So, for example, a factor that just happened 2 weeks ago, China announced the greatest economic stimulus in the history of China.
Right.
So that's going to create inflation.
Yeah,
globally.
people will be like, I can't see it yet in the Chinese CPI. Well, can you see it? Like, the Shanghai Composite Index went up 29% in 6 days.
Right.
That's, if you can't see that inflation, it's not in your account. You're not long China. But that, like, to me, it's just still, it's not a political point. It's more of a, like, where is America going to go with this? Because if you can't get away from the entitlements, and you can't get away from the deficit, and you can't get away from the Fed now going back to the money printer, you can't get away from inflation.
That's right.
Higher for longer. But someone like me is more likely to believe that for definitely the next year, right? Because, guys, you can show it on slide 26. Like, again, Bloomberg consensus estimate has inflation magically, and this isn't 2.5 times of magical things that are happening. I mean, this is, I mean, I'd shave my head and do like whatever you need me to do if that number comes home to roost. Whereas, we have the inflation reaccelerating because we put the commodity price sample basket against, with oil's the heaviest factor, put that against the base effects, and it's just math, right? The Federal Reserve will be like, I don't want to talk about that math. I'll blame. I think they were kind of hoping for the port strike, because then he would have blamed the port strike on Q1 inflation, like he blames supply shortages on 9% headline inflation. But I still can't get away from kind of this. If I take your view that it's beyond 2 years and it's well into the end of what we call the fourth turning, are you familiar with that demographically? The fourth turning?
With the fourth turning, but I know where you're going.
The fourth turning, Neil Howe, who's my partner, wrote this book called The Fourth Turning, and it's just there's death, taxes, and demographics. I mean, this is just the age of the population and the loss. What happens is a degeneration, in this case, the baby boomers, both parties become the same thing. They both screw up every way that you can, and it collapses on itself, and the next generation's got to pick up the pieces, right? So we've entered, this is like a 25-year cycle, 30-year cycle. So we've entered that, and we've entered it as inflation's about to take off again in terms of how even they talk about inflation, right? So I wonder, like, do you have like scary thoughts, or like you have investing thoughts on that? I'm sure, but is that scary you?
Well, it has a good side and a bad side. So here's the good side. The good side is that in China, their standard of living is, if they're lucky, 1/5 of our standard.
If they're lucky, yeah.
If they're lucky.
Yeah.
In India, if they're lucky, and they probably aren't lucky, their standard of living is 1/10 of America's. So you can imagine a world where China has a standard of living 1/3 of America, and India has a standard of living 1/3 of America. Can you imagine the demand for all manner of commodities? That's going to happen because we live in the information age. The population of the world is not going to accept perpetual poverty.
Yep.
So they had to be provided for. So in that sense, that's why I'm sympathetic to the Federal Reserve. Whatever happens in China, whatever happens in India, and many other countries as well, is more or less outside their ability to control.
Mm-hmm.
So those nations are going to need every conceivable kind of commodity. And developing commodities, it takes, in many cases, many years, in some cases, decades. And we, in the global arena, we haven't been spending the amount of money we need to spend to develop those resources. And we haven't even mobilized the capital that we need to spend if we were to develop the resources. Mm-hmm. So we're way, way behind.
Yeah, I think, I mean, have you read the book Fossil Future?
Yes.
Do you like that book or not?
Yes, I do.
Okay, because you know what you're talking about. So to me, I don't know what I'm talking about on that, so I'm just trying to educate myself. And I thought it was excellent. Epstein wrote that book, and it was the answer to ESG, because he says essentially that you can't have a debate about this without arguing both sides. Like, you're gonna cancel on the basic needs of humanity so that you can have a policy that makes you feel better. Like, essentially, that's what he's saying. Whereas he uses the example: if you gave the power of a refrigerator, which is basically a luxury in Africa, to X amount of people, you would change their lives for good. I mean, so that whole concept of saying, or we're going to underinvest, he recasts it in a very different way. You're underinvesting in the progress of humanity, and you're resting on your established laurels in the U.S. I mean, that to me is kind of the point of the book.
Well, the United States, the end of the Second World War, they were the world dominant economy.
Right.
The CIA World Factbook, according to that calculation, on a purchasing power parity basis, China is now a bigger economy than America's economy. So they're well able to get their natural resources if they need it, and they need it. So it's going to happen, and it has nothing to do with whether policymakers approve it or not. Just one of those things. It's outside their ability to control. No need to blame them, because it's just going to happen.
Yeah, and you've actually, like, in terms of like what to do with it, you know, like I said, do you come out with a scary outcome? The answer doesn't have to be yes. I mean, it's actually a very bullish outcome if you're long of hard assets, if you're long of the things that are inflating, like I said. Well, I'm not long cheese and beef, but you know, the INFL ETF is loaded with these things that you wouldn't be like, I think the return is actually better than the market. It doesn't even have the Mag 7 in it, right?
Yeah, historically, yeah, it doesn't have any of that. Historically, the wealth of the world was hard assets. So why was the wealth of the world hard assets? Not that we had plenty of technology in the 19th century, because the pace of technological change is such that it gets displaced by some other technology. That happens. This was the last technology cycle was very unusual in that it took longer than it normally takes. But eventually it gets displaced. So if you look at the S&P 500 in, let's say, 1970s, a lot of companies are companies that produce tangible assets. Look at the S&P 500 today. There's nothing. I don't want to say nothing, but maybe it's a stretch in imagination, but it's not a big stretch. There's next to nothing. And it's going to normalize. So what's going to happen? The biggest pool of resource of capital in the world is the capital that follows the S&P index. And it has, as a practical matter, no tangible assets in it. So one day that's going to be equilibrated. And so there is no pool of capital that's sufficiently large to be able to absorb the S&P as it exists. And there is no supply of equities you could buy that's sufficiently large to absorb the capital if they could get it out. So it's going to be very disruptive in an equity sense, in my humble opinion.
Well, I mean, you take, you know, if you just take NVIDIA and Apple, there's 15% of it right there almost, right? Of the S&P 500 at this point.
Yeah, well, NVIDIA's, I guess NVIDIA's almost, it's almost 15%, you're right.
What I love about that is like the people who keep telling me that the Hall of Fame year of inflation, we've killed inflation. Just wait until tomorrow, because for us at least that'll be the low print for the cycle, and then we reaccelerate again. You hear them say that, and on the same token, they're like, I love Apple and I love NVIDIA. I mean, all their products do is inflate. You know, it's not like you go buy an iPhone for $50.
Well, it is expensive. That's true. But I certainly wouldn't blame inflation on NVIDIA or Apple.
No. I just think it's like it's interesting to listen to strategists and certainly Fed heads. You know, I'm much more critical of them. I think it's toxic to my kids. Like, you know, when my son was actually asking me yesterday about some of the things that you're highlighting. He's like, Dad, do you know like how many young people there are like in Saudi Arabia? And he's like, because in 11th grade, this is what they're studying right now. I'm like, yeah, I know. And he's like, well, what's going to happen over here? And I like having like a real conversation about real things. Whereas top down, if he were to turn on CNBC and listen to these people talk about what's happening with inflation, he'd be fed a spoonful of things that like would confuse him at best, but certainly not be close to the truth.
Well, the way I look at it is this way. So one of the miracles I talked about earlier, 3 billion people came into the world labor market.
Yes.
It's a miracle for disinflation.
Yeah.
The same 3 billion people would like to share in the good life
Yes.
that the people in developed countries share. It's a naturally human thing. There is no number of policymakers that's going to be able to stop that trend.
It's interesting. Like one of your new holdings, Landbridge. Do you mind talking about that?
Sure.
Because Landbridge has like a lot of the things, the basic needs in it.
Well, the Permian Basin in Texas, so we're Landbridge, just so you know, it owns land. And there's some oil-bearing properties, but a lot of land is not oil-bearing, but it does have water. And you're going to need water for data centers. But first, to position where it is, if you can imagine, or maybe you look on the internet, where the Texas and Mexico border joins, there's sort of a backwards L. That's their property.
Oh, okay.
That's more or less where it is. So to build data centers in developed areas is problematic now. First of all, data centers are bigger. The data centers generate a lot of heat. The data centers require extraordinary amounts of power. There are data centers that are planned that require gigawatts of power. Local utilities just can't supply that. If they could supply it, they couldn't supply the water. So it has to go into a non-populated area where there are supplies of hydrocarbons that can be used for generating electric power. So it doesn't have to necessarily be on land bridge property, but even if it weren't, there's plenty of water there, and there's going to be right-of-way for water piping. Water piping, by the way, doesn't mean hard pipes like you think of. It's just, it looks like fire hoses. They call it flat hose. So there are a lot of wonderful things going to happen, and I suspect, even if none of that ever happens, the price of natural gas, which in many regions of Texas is actually negative, if you can believe that, because there's no way to bring it to market. If it becomes modestly positive, can you imagine the swing in the profitability of certain companies? That's what's going to happen, in my humble opinion.
Well, water's been a tough one to monetize, albeit it's like one of these glaring, supply pictures where you're like, a lot of it's underinvestment. There's, what's happened with I think it's called the Oquagala? How do you pronounce that? The aquifer, the biggest aquifer between Arizona, California, Aquagola. These aquifers are basically being bled down to nothing. Right?
Well, that's true, but more to the point that in the municipal areas, the municipal water system, let's say New York metropolitan area, was designed in the 19th century. So it was not designed for a data center to draw 1.5 million gallons a day. Just wasn't designed to do that.
Right.
So you can't blame the planners in the 1890s that they didn't envisage data centers with NVIDIA chips. They did the best they could, and as far as I can see, they did a pretty damn good job of it, but we're not set up to do this.
Yeah.
So we need to go into an unpopulated area, and the most logical place to me is the western regions of the Permian Basin, which is known as Delaware Basin.
Okay.
So that's where I believe it's going to happen, or a lot of it anyway.
And land in general, because land bridge. So you have land, you have water, you have all energy. It's a coagulation of assets.
Yes.
Okay. Whereas TPL, Texas Pacific, which you've owned forever,
Yes.
is that more land, or do they have the water component as well?
No, they have actually more land, but oil is proportionally a greater part of the revenue than it is in land bridge. So they just have more net royalty acreage, and it produces more. So their hydrocarbon-related revenue is higher as a percentage of total revenue than the comparable figure for land bridge.
If you pull up a long-term chart of TPL, you guys can all do it if you're sitting in front of your screen. I mean, it's like, what's interesting about what you're saying, well, there's a lot that's interesting. Everything that you're saying is interesting, but like on what the future is going to be, it's already here in some of these stocks, and not just like in the last year. Or in fact, because you've owned TPL for what, 25, 30 years?
Well, almost the entirety of my career.
Okay. So can you talk about what that asset looks like from now until however long you want to go versus what it's become to this point?
Okay, well, what it is it's very simple. Most companies, I call this one of the greatest companies there are. The only reason I hesitate not to say it's the greatest company is I don't know every company. Maybe there are some that are greater, but it's one of the greatest I've ever encountered. The reason it's one of the greatest I've ever encountered is because there are very few companies that have the following faculty. The faculty is, in most companies, you have a certain amount of earnings. They all belong to the shareholders legally, but practically speaking, a certain proportion of the earnings had to be reinvested in the business to just keep it as business. If you're a royalty company and a land company like Texas Pacific, you really don't have a reinvestment requirement. So you can do one of two things. You can either return the money to the shareholders, or you can buy more of the same assets that they have. That's it. So when you compare it on a valuation basis, most companies, when you look at its price-to-earnings ratio, you don't really own all those earnings, practically speaking. So you have to make an adjustment. And what happens is they can't even calculate, under general accounting principles, the proper P ratio of a land company, because under American accounting, we don't mark to market the land. So if there's a certain amount of inflation, whatever that number might be, the land is appreciated in value, but it's not sold. So under foreign accounting, you value land, and it's part of comprehensive income. In American accounting, you don't do that.
So you must love the Kamala idea of taxing unrealized capital gains.
Well, I don't like them. I don't. I think most people don't like taxing unrealized capital gains. That might be pretty expensive in my case.
Well, it's a thing, and you've always liked royalties in
Yes.
terms of a structure. And the one that comes to mind as somebody who's as bullish as we've been on gold as of late is Franco-Nevada, because it really has been a bit of a dog compared to what it's been in the past. I mean, this thing has been a horse for a long, long time, and I don't know what particularly happened there, because I don't pay attention. But did they have some issue with one of their major mines?
That was a problem in Panama.
In Panama?
Yes, in Panama. That the population in Panama, it's a copper mine, actually, but gold is frequently found in the presence of copper.
Okay.
So the idea would be mine both, of course. The population of Panama, in a referendum, decided in their infinite wisdom, they would rather leave the commodities in the ground. So, of course, that makes it a bad investment.
Mm-hmm.
So that's the bad part. There's one other part of Franco-Nevada that you could argue in the short run is bad, the long run is really good. And what's the bad part? The bad part is that somewhere between 2/3 and 70% of our assets are not producing any gold. So they invest money in royalty streams that are not currently under production.
Not currently.
Not currently. And they won't be unless the price of gold is considerably higher.
Oh, so it's just not the 7 years that it takes to get these things up
That's
and
right.
running.
So
It's not cost
it's not
effective?
cost effective because eventually they'll come into production. There's some price that'll bring it into production.
So Franco-Nevada, which it has been in the past, like when gold's already at all-time highs, but let's say it has a 3 and a 4 in front of it instead of a 2.
That's right.
Franco-Nevada is the most levered way in terms of fixed assets.
That's right. At some point, whatever that number is, there'll be a lot more gold production, and it goes to the bottom line because it's a royalty.
Yep.
So I thought they were pretty forward-looking in doing that. The reason is, you might say, well, why didn't they buy things that are producing currently or have the prospect of producing currently? And the reason is, when gold is doing extraordinarily well, how many companies really need capital to develop a mine? Mm-hmm. They really don't. Mm-hmm. So you won't get a good deal, if you can even make a deal at all. Mm-hmm. So necessity is the mother of invention, and they took that pathway. And I think it's a sensible pathway.
Does INFL still own FNV?
Yes.
FNV is Franco-Nevada,
Yes.
for people that don't know. What other royalties do you like a lot?
Well, there's a small one called the San Juan Basin Royalty Trust.
San Juan Basin. What's
Yes.
the ticker?
It's SJT.
SJT.
So this has more or less $150 million market capitalization. It's very small. It's in INFL. And so
It isn't, or it is?
It is. And it's located in northwestern Mexico. It's 99.8% natural gas.
Did you say New Mexico or Mexico?
New Mexico,
Yeah.
not Mexico, New Mexico. And their gas ends up going to California. So their gas is sold to California at a premium, but the negative thing is, 2 negatives. First negative is that price of natural gas is down.
Yep.
Second negative is, in this particular case, the operator of royalty, a company named Hillcorp, has dramatically expanded its capital investment program. You might say it's a good thing in the long run, but in the short run, if you're a royalty, you have to pay your pro rata share of the capital expenditures. And that can only come out of the existing cash flow. So the cash flow is inadequate to fund the pro rata share of capital expenditures. Therefore, the dividend was reduced to zero.
Oh, really? Okay.
So there's no dividend, and therefore the stock has declined.
So that's where you find opportunities where you get these dividend cuts or lack of production yet at a cost-effective basis. That's where you get opportunities.
Well, there will be the day will come when there'll be increased production.
Right.
And because from the point of view of the operator, you're really effectively you're lending the royalty trust money at no interest.
Yep.
And with no recourse to royalty trust, because if there isn't any cash flow, you're not getting your money back. So we're pretty confident that it'll work out in the fullness of time.
Well, it's an interesting one. I mean, I've been buying natural gas for the first time in forever, thankfully. Natural gas, I mean, if you have, certainly your view, never mind my views, much shorter term in terms of like the next year of at least inflation reaccelerating, you know, you're just seeing, like I said, every single day we measure and map every single commodity that ticks all the way to salmon prices. We talked about beef and cheese. They're all just doing the same thing. My signal's doing the exact same thing, which is fractal in nature. There's similar sets. When this takes off, the rising tide lifts all the boats. And if they're lifting the natural gas boat, that's like one of the heaviest boats.
Well, it is.
And,
yes.
And is that something that, like, is that sustainable? Because I think that of all the things that people wouldn't have believed up until 3 months ago, is that Chinese stocks and natural gas could break out in macro.
Right. Well, at the end of the day, China doesn't have enough natural gas. Won't be buying it from the United States, primarily because there aren't a lot of ways to export natural gas to China. If we had export terminals on the Pacific coast, that might be another thing. And maybe one day we'll have it. But for the moment, we don't have it. What we do have is we have enormous planned construction of data centers. That's going to require electric power. And the modality of choice is going to have to be, by default, natural gas. So it will appreciate in the fullness of time.
Do you think people understand? I mean, I think almost any investor should, if they're alive and ticking, paying attention, should know the copper link to AI. But do you think they understand the natural gas link?
I don't think so.
Yeah, I'm long natural gas. I wouldn't have. That wouldn't be my first talking point.
I don't think it's well appreciated how big the expenditure actually is going to be.
Yeah, true point.
But we're talking about the next 12 months, something on the order of $250 million, $250 billion conservatively, to build new data centers. We just don't have the power. Put it another way, if you go on the website of the Energy Information Administration, what you'll see is the United States power consumption since 2007 is literally flat. It's, I think, 4,000 and some odd gigawatt. So that's like 4 terawatt. That's per unit of time. That's not a cumulative number. So per hour, that's what we're consuming. And basically what was able to happen is, as the industry left America for greener pastures, the data centers, such as they were able to absorb that electric power production capacity. It's no longer adequate. We're going to have to build. And it's unlikely to be coal. It's possible, but I think it's highly unlikely. Oil is not really suitable. Occasionally it does happen in certain unique geographical areas, but it's less than 1% of all the fuel that's used for electric power is oil. So that's out. You have nuclear. The trouble is the data center requirement is now, and it takes too long to build nuclear power, if it's even permissible. And then we have the intermittent sources, solar and wind. But data centers are constant. And we can supplement, but we can't rely on solar and wind for that. So the vehicle of choice is, of course, natural gas. So that's going to happen.
You need reliability, you need the supply, predictability.
And it's inexpensive as well.
Wind and solar is basically the opposite of what I just said.
Right. So it's by default.
Yeah.
At the moment, it's in plentiful supply, but that's because we haven't built the requisite power plants. But they will be built.
First and foremost, welcome to Hedgeye Nation. Make no mistake, my number one goal is to help you preserve and protect your hard-earned capital. Who helps you with that? Like, how many people have actually helped you preserve and protect that capital? They can't. They don't have a process. You need a better way. We need to get better each and every day. There's a lot of baggage out there. There's the old wall, a lot of bullshit. There's CNBC. That's not who we are. We have a process. We're going to help you get better. We have a team of over 40 analysts that are going to help us do that, and I'm looking forward to it.
Hedgeye founder and CEO Keith McCullough's long-awaited new book, Master the Market, is available now. In this 52-page ebook, Keith McCullough distills decades of Wall Street experience into actionable insights. Discover how to navigate market cycles, avoid major losses, and invest with the confidence of a seasoned pro. Download your free copy right now. Go to hedgeye.com/book. That's hedgeye.com/book.
So San Juan is like a real levered bet on natural gas.
That's right.
Because there's no expectation, and people wouldn't understand, like unless they just listened to you, why you'd be long natural gas through the lens of data center needs. That's amazing. We have a couple minutes left, and I wanted to get your thoughts on Bitcoin, crypto. You were very early, and I think to some it might have even been peculiar, right? Because you're conservative in nature in terms of how you articulate ideas. I don't mean politically, but I mean you understand the subject matter better than most, and if not the best. And you're not supposed to buy crypto, Bitcoin. You're like, what's wrong with you? Like,
Well, they may say that, but it's not so. So basically, the problem, crypto wouldn't have been crypto were it not the blockchain. So the problem, basically, if you read the book by Hayek, written in 1977, I believe, The Denationalization of Money, he poses a problem thusly. You'll never solve the problem of inflation until you separate truly the central bank from the government.
Yep.
The trouble is what's called in the crypto world the authentication problem. So the government says, or the central bank says, we are printing up only so much money. Of course, now they don't print it, it's electronic, but nevertheless. How do we know that's really true? Because there are so many different ways of measuring the money.
Mm-hmm.
We didn't know how to solve that problem until the blockchain. So once the blockchain came into existence, now possible to design a protocol, we can know with specificity exactly how many units of currency are in existence. Even gold, historically, gold was backed by money. And if you examine the United States of America, first the gold backed the money, then they changed the reserve ratio. Maybe you only needed 50% gold backing, maybe you only need 33% backing, then you only need 25% backing, they need any backing. So even with gold, it's possible to manipulate.
Mm-hmm.
So with Bitcoin, there's 21 million units going to be outstanding. There's 19.8 million roughly right now. And the number is going to be reached in the year 2140. And now we know it's the most conservative investment there is, because it's a solution to the ultimate problem of the central bank. How could you not buy that?
And the way you describe it, I mean, it is the ultimate, like for somebody who starts with supply and demand, it's the ultimate depiction of what you want.
Because all the monetary or financial conservatives will agree, if they agree on nothing else, they agree on this. We want a fixed money supply.
Yep.
So there it is. So why wouldn't you want to buy it? It's the most conservative investment you can possibly make.
Mm-hmm. Bitcoin. Now, of course, there are loads of frauds that have been revealed in crypto. And it's like the history of the world. You know this better than anybody probably. I mean, as soon as you see a boom, the fraudsters and the hucksters come in, and that happens. But it doesn't mean that the internet didn't happen, the railroads didn't happen. You can keep going back to things that happened. Autos, like there are plenty of these issues. It gave it certainly. Sam Bankman-Fried didn't add to the branding of the whole thing. But do you like first of all, do you agree with that? And secondly, do you see a bunch of crypto that you buy into and believe in, or is it just Bitcoin?
Yes. Well, ultimately, there'll need to be some other cryptos. The reason there need to be is because Bitcoin only has a 4 megabyte block size.
Yep.
That's by design. So at some point, there'll be a limitation to how many people can transact in Bitcoin.
Mm-hmm.
So you might have a situation where smaller numbers of people, or a lot of people with small transactions might want to transact in a cryptocurrency, which has the same monetary policy as Bitcoin, but doesn't have that much of a block limitation. It might be Litecoin. The reason I bring up Litecoin is people will be astonished, but if they will look up the trading volume in dollars,
mm-hmm.
coins means nothing, it's dollars.
Yep.
Believe it or not, even though the market capitalization of Litecoin is a fraction of the market capitalization of Ethereum, the dollar trading volume of Litecoin is equal to, and some days surpass, the trading volume measured in dollars of Ethereum.
That's impressive. I did not know that.
So that's objectively verifiable. So there are people using it. So Litecoin has a very high velocity. So there are people who have found a use case for it. And I think it's going to come into its own. So you might say, why didn't it appreciate? I don't want to give people a too esoteric comment, but I'll do it. See, there are different vectors that control the price of cryptos. And one of the vectors is the price of mining, the cost of mining, really.
Yep.
So in the last 5 years, it's gotten very cheap to mine Litecoin. Why? Because you can do something called merge mining. What merge mining means is, for the same electrical current, you can mine 2 coins, not
Oh, really?
one. So if you'd like to accumulate Litecoin, you can mine 2 coins, sell the coin that is not Litecoin, use that for your hosting expenses. Now you're not
you
paying
fund it.
anything for electric power to mine Litecoin, and have money left over.
That's interesting.
So what that does is, in the long run, it helps you accumulate a lot of Litecoin and not expending any money. It's like mining Litecoin for free. The bad thing is, in the short run, it lowered the value of Litecoin. Because like any commodity, cryptocurrency is a commodity, if it becomes more expensive to produce, it will trade at a lower price. Just like if it was cheaper to frack oil, it would trade at a lower price. Same thing with crypto.
Well, thanks for saying that, because I mean, I've been saying that crypto is a commodity since the beginning of crypto, and I get criticized all the time because the people, that are of that village, so to speak, that don't do anything else, they don't put it in context. I'm trying to put it in the context of what asset allocations in the world can I make, what has what volatility attributes, and it's certainly crypto. Well, it has even higher volatility attributes than something like natural gas, depending on the coin. So it's more of a volatility adjusted point, is that we put it in the commodity bucket. And I like how you frame that too. And also, we have a lot of things in common in terms of how we analyze things. And the dollar-based flow, that's a really astute call out. I mean, the last question really has to do with that. We measure and map the flow of crypto. We have a crypto team that's led by Josh Steiner and Ish, who's sitting over there, who I'm going to immediately ask about Litecoin after our discussion, because I don't own it yet. But the poly market, I mean, the amount of poly markets on Polygon, right? I think that's what it is, but I know what poly market is. The amount of dollars, Murray, I mean, this is incredible volume. And it's all in the blockchain, right? This puts to bed any betting that people have had certainly on political elections. That's been a huge eye opener to me. Is that something that you like or don't like?
That particular currency, well, I don't really know it. There are only so many hours in a day.
Right.
I don't know every currency, and I'm not sure at this stage which ones will emerge to be the dominant ones. But I have noticed the volume, and it's definitely there, and that is an indication that it's gaining acceptance.
Yes.
And just to complete the thought, in the 19th century, we think about dollar, but the dollar was banknotes. So we're all dollars, but they're issued from different banks. There were 5,000 banknotes circulating in the United States before computers, if you think about it. So with computers, why shouldn't there be 5,000 cryptocurrencies circulating that have value? So we're not going to master them all, just like I couldn't master all the banknotes in the 19th century. You find the ones you're familiar with, and those are the ones you would accept. But I believe we're going to go back to that world. The world in which people undertake to act outside the bounds of a central bank, that's a natural way the world works. We don't have to abolish a central bank, just need to act. So for example, Abraham, as you know from your Bible, purchased the tomb of the patriarchs to bury his wife Sarah for so many shekels of silver, and there was no central bank. Somehow they figured it out. So for the bulk of history, goods and services are being exchanged without the services of a central authority. Crypto is just bringing ourselves back to normalcy. The world in which we grew up is the world of central banking, and the reason it's the world of central banking is We could never have fought the wars we fought in the 20th century without central banking, because we never could have mobilized the resources we need to fight wars on that scale. But we can't fight wars on that scale anymore without destroying the planet.
Mm-hmm.
And therefore, logically, people will choose, it seems to me, going back to the world that we came from. So for 49 of the 50 centuries that we have recorded history, we didn't require the services of a central bank to exchange goods and services.
I'm super happy that we had this conversation, because for such a long time, like, I've been waiting for somebody to articulate the why. On Bitcoin and crypto, we separate the two, but just by the volume. They're two different things. And maybe they won't always be, but for now, we do separate the two. And I just don't like the explanations I get from the hodlers and the laser eyes. That doesn't mean that they're wrong. Don't tell them that. I'll be attacked by hornets on Twitter momentarily. But it does mean that there are a lot of people like me that have a global macro framework, and they want to put it inside the global macro framework, not only in terms of measuring and mapping the volatility of the assets and how they trade, volume, price, volatility, et cetera, but in the context of long-term history. Right? That is a super valuable thing that you gave.
Well, if I might suggest to people just a slightly amended way of looking at the world. So people look at Bitcoin as if it were a stock. So if it's up, people will say Bitcoin is up 1% today, as if it were a stock. But it's the wrong way of looking at it. If the people said the following thing, Bitcoin or the dollar is down 1% in relation to Bitcoin, or if they said the dollar has lost 99.99% of its value in relation to Bitcoin since the inception of Bitcoin in 2009, it'd be a different way of looking at life.
Yeah.
So what it really is not that the Bitcoin is going up in value, it's the dollar is losing its purchasing power in relation to Bitcoin.
Yes.
And therefore, if somebody wants to protect against that, Bitcoin is the salient asset. It's even more valuable than gold in that sense. The reason it's more valuable than gold, if the price of gold were $5,000 an ounce, merely for the sake of argument, a lot of gold would come in the ground, probably a lot of gold would come out of jewelry.
Yep.
Bitcoin is really fixed supply. Gold is not fixed supply. In history, when the conquistadores conquered the Americas and brought the gold back to Spain, gold was money. Gold created inflation. Historians call that the price revolution. It's a polite word for inflation. So you could have gold-based inflation. It's possible. If enough gold were mined, it's theoretically possible. I don't suspect that's going to happen anytime soon, but it could happen. Mm-hmm. Bitcoin is really fixed issuance.
Yep. That really helps me understand it more. I'm about to buy more Bitcoin. I'm going to look at this Litecoin situation, and I'll come back to you on it, because I love to hear what my analyst says back, because I just don't know. I mean, but I'll buy anything. Like, if it's a commodity,
okay.
I'd buy or sell anything. I think most people who know me know that. So thanks for the education.
My pleasure, anytime.
Yeah. I don't know if anybody can give a better education. Again, contextualizing where we are, where we've come from, most importantly, across long histories, to handicap the probability of where we're going next better than Murray just did. That was a masterclass. I was fortunate to be on the other side of it, just listening and asking some questions. Thanks for being our audience for today and yesterday, and tomorrow we're going to do it for the final day of the Investing Summit, and we'll appreciate your audience.